The bond market seems to at least be implying or hinting that the economy is slowing down enough to potentially risk a recession. But yet the stock market is sitting at or near all-time highs. Can you please square those two things for us?
Sure. Good morning, Brian. So the bond market, 2% 10-year yield in a 3% economy. Yields have come down over 100 basis points over the past, 9 months or so. Clearly, the bond market is getting priced for a recession, but I think what it is saying more is it's telling the Fed that it needs to cut. And of course, since last week's FOMC meeting, the Fed is basically saying, we hear you loud and clear, and there's even some talk about maybe a 50 basis point cut in July. But the market is pricing in 3 rate cuts or so, and the Fed is now saying, okay, we're kind of poised to go there if things get worse. And of course, the stock market likes that, because when you have a Fed pivoting to an easing stance in an ongoing expansion, and with very low probability of actually getting a recession, historically that's proven to be a very bullish recipe. And then if for somehow we manage to get some sort of trade resolution on top of that, I'm not holding my breath on that, but if we did, then you get a really potent combination of events that could drive stock prices higher while keeping bond yields low. So it does remind me very much of the 90s, whether it's the 95 cycle or the 99 cycle, but it is a little bit of deja vu there.
Yeah. Well, the 95 cycle, where we had rate cuts as a market was going up, turned out okay for a few years. We had a number of years left of that bull market run. The 99 cycle you're in, I don't need to remind our viewers and audience what happened in 2001, tech collapse, NASDAQ implosion, prolonged recession. I guess I just did remind them. Which of these scenarios is more likely? Could we still get a couple more years of a bull market stock run?
I think we can. I mean, market cycles are not static systems, right? They're dynamic, and they're driven by things such as the yield curve and excesses in the system. And right now we don't have a lot of excesses. Corporate debt levels are high, but certainly household levels are not. The financial system levels are not. So we don't have a lot of those looming imbalances that we did, for instance, in the late 90s, but especially in 07 with the onset of the financial crisis. So I like the 95 analog, but clearly the economy has expanded into a late cycle mode, and it can stay there for a while. And if the Fed is sort of just in time with its response, it could be a cycle extender for sure.
As you yourself have written, the British stock market should be maybe a good roadmap, because with all the uncertainty around Brexit, we have seen multiples in the British stock market come down. If you don't know what's going to happen, you have to bring down those growth expectations. But yet, we're in the middle of a multi-pronged trade fight. The increased tension, of course, with Iran. Fair to say, a lot of uncertainty. And yet, Jurrien, we've seen multiples expand a bit here.
Well, so the PE ratio on forward expected earnings peaked at 19.5 about a year and a quarter ago. Fell to 13.5 in December and is now back at 17. But you raise a good point. In the UK, they had their referendum on Brexit in June of 2016. In those 3 years, basically nothing has happened, right? Companies start sitting on their hands because they don't know what the rules of the road are going to be. And so during that period, the stock market there has done all right. Earnings are up 30% in 3 years, so that's a very good number. But the PE went from 16 to 12. And in the U.S., I'm not expecting that exact scenario to unfold, but you could have a scenario where the market does well, earnings do well, but as companies sit on their hands waiting for the rules of the road for China, maybe like less happens there, and investors want to get compensated, and maybe you see some PE erosion, and which has already happened in some way, but maybe we could see more of that. That doesn't mean the market goes down necessarily, because if the earnings offset is positive, then price kind of like stays in the middle, and that I think that's not a bad roadmap for the U.S. here.